Good morning. It's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of August the 2nd. Can't believe it's August already. What a great summer, warm summer, and this weekend did not disappoint. So I spent a lot of time on the water, the lake. Hope you had a wonderful weekend. So let's talk about what happened last week and what's going to happen this week. So last week, we floated into Thursday and Friday, floated rates into Thursday and Friday. And as I talked, we discussed that we probably would see rates or had a potential to see rates go up because on Thursday, the adjusted GDP numbers came out for the second quarter. GDP is a gross domestic product, gives us an indication of how well the economy is growing. We expected 8%. And it was a miss. It came in at 6.5%. Rates actually did not get worse on Thursday. They actually went down Thursday. And then Friday, the PCE, which is the Federal Reserve's favorite measure of inflation. We know that inflation, when it goes up, mortgage rates, generally rates go up. Why? Well, let's say you have $1 million in bonds and the yield's 4% and the inflation is 1. 1 minus 4 means your rate of return is 3%. Now take that 4% bond of 1 million and 4% yield, and now inflation is 3%. Now you're getting a 1% rate of return. So what happens in this situation? Those yields start to increase, so investors keep their rate of return. And so mortgage-backed securities, we know, are traded in the bond market. So when we see bond prices go up, we see mortgage rates go up generally. PCE came in high. Inflation's up. We've been talking about this all year, that we'd see inflation creep up into the middle of the summer, and it hasn't disappointed. But the Fed is just offsetting any increase to those rates by saying we really don't care. We're going to continue to pump billions of dollars into buying mortgage-backed securities, and that's keeping our rates down. And so we're enjoying a phenomenal rate environment right now, and we've actually seen rates improve over the last. When I put my hand up, that means bond trading is going up and mortgage rates are going down, and we've seen this happen over the last few months, and it hasn't stopped. So what are we looking at this week? First week in every month is jobs reports coming out this week. And then the second thing is COVID. And that's the only two things I'm going to focus on this week. So first week in every month, a lot of jobs reports coming out. We got a lot of them coming out today throughout the week and really every day. And so will we see more jobs added? And will the GDP numbers that were a miss on Thursday, will that reflect into less jobs being added? Because if we see fewer jobs, that's a shrinking or a economy that's not doing as well, and that could cause those mortgage rates to go down. And we know that the only way to really grow our economy isn't to spend our way out of it, it's to work our way out of it, grow businesses. And if people aren't working, if they're not going to work, that is an impact on our future economy. So if we add more jobs, though, let's say that more jobs come in, isn't enough to make the bond traders believe that it's good for the long-term economy. Remember, bond traders look long-term. They're more conservative. They're looking at what projections are we going to see long-term. And mortgage-backed securities, again, are traded in that bond market. So if they're putting more of their emphasis on buying bonds, investing in the bond market, that's going to keep mortgage rates down. So will we see a sell-off in bonds if jobs go up? Will the bond traders just not believe it's good for the long term because they don't believe the numbers? We'll see. COVID, second thing. So obviously more cases going on around the country and around the world creates uncertainty. And when we have that uncertainty about will this affect future growth in our economy, will workers stay home, will they continue not to go to work, that has the potential to cause a problem, long-term growth. And if the bond traders believe that, they're going to start parking the money in that safer bond market, even though they're getting a lower rate of return. It's safer in the long run, and that's going to drive mortgage rates down. And then you add the Fed, who's absolutely said they're not going to taper anytime soon, maybe the first part of 2022. And a couple months ago, they were talking about maybe the third or fourth quarter they'd start tapering. So that's been put off. So they're going to continue to buy those mortgage-backed securities in the billions of dollars. That's going to keep mortgage rates down. So how is COVID going to affect the long-term growth of our economy or the outlook this week? And will money start moving back into that or into the bond market and drive those mortgage rates down? We're really going to look at this and obviously watch the reports that come out. So heavy week on jobs reports this week. Will those jobs reports move rates up if they're strong? Will COVID fears offset the strong jobs reports if they come in that way? Just some unknowns. So we're floating right now until we start to see some better indicators. If we see some movement up, obviously we're going to change to a locking position. So if you or your clients need any advice on locking, please give me a call. All my information is down below. If you know somebody who can benefit this video, please forward it to them. If you have any comments, I'd love to hear them. Have a wonderful rest of your week, and we'll talk to you next week. Bye-bye.